By the way, as gold is still not that far off from the prior peaks. Right? And I think that if that ends up getting overtaken, which I think is possible, because again, as a diversifier, gold does tend to also act like a risk-off safe haven trade for a moment in time. I would expect gold to do well in a flight to safety sequence, which we could be on the verge of, as spreads widen. And it then makes sense, right, for that momentum trade to really finally work after years of frustration.
Investors and traders need to keep an eye on gold's $2,000 an ounce level next week, as the market navigates further volatility created by the Federal Reserve's expected hawkish higher-for-longer monetary policy stance, according to some analysts. MichaelGayed, the author of the Lead Lag Report and portfolio manager at Toroso Investments, is a respected figure in finance. He anticipates gold will surpass previous peaks as a safe haven asset and sees it as an excellent non-correlated option for diversification. On October 27th, Gold Silver posted on X, "Global demand is strong for gold, and concerns about escalation in the Israel-Hamas war provide further upward pressure." Furthermore, Michael also predicts that during a bear market, big institutional players could start adding gold to their portfolios. Before late September's hawkish 2024 dots, gold's total sell-off was 7.9% at worst. That was still pullback grade, meaning gold's up leg was technically intact. But as that post-hawkish-surprise sell-off mounted, gold edged into formal 10% plus correction territory as October dawned. A few days later, gold's total sell-off extended to 11.3% as that recent nadir was hit. Gold rolling over into a correction reset its up leg cycle. Michael sees the Fed potentially adjusting its balance sheet during the market crash. If the Fed has hit the peak interest rate for the current tightening cycle, savings rates might have maxed out. The FOMC anticipates one more rate hike in 2023, but bond market investors appear doubtful. Now, we present the clips of MichaelGayed insights from his recent interview with Commodity Culture. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Now, gold is the ultimate non-correlated asset. By the way, not correlated to anything. All these narratives around gold is correlated to dollar, to stocks, to bonds, maybe in momentary rolling periods, but for the most part, gold doesn't really correlate to anything, which makes it a diversifier, right? Because the very idea of diversification is around correlation. So if I'm right about a credit event, if we are still in a bear market, probably some of these larger players starts to say, you know what, we need to diversify. So what do? Let's maybe go into gold. Let's up our gold allocation from nothing to 2%, 3%. Let's up our 3% allocation of 4 or 5 at the margin. Now, if you get enough big players doing that, that sparks, I think, a self-fulfilling momentum cycle. By the way, as gold is still not that far off from the prior peaks. Right? And I think that if that ends up getting overtaken, which I think is possible, because again, as a diversifier, gold does tend to also act like a risk-off safe haven trade for a moment in time. I would expect gold to do well in a flight to safety sequence, which we could be on the verge of, as spreads widen. And it then makes sense, right, for that momentum trade to really finally work after years of frustration. I think they could be forced to pivot if you have a very sharp credit spread widening type of dynamic, which is a VIX spike, which is a crash. Doesn't have to play out exactly like 1987, but typically, there's a reason why there's that expression of staircase up, elevator down, right? And if I'm right that we're in the credit event, and phase 2 of the credit event is the corporate credit event, and that starts with this widening that's happening at the margin, it can get out of control very quickly. If it gets out of control very quickly, the Fed, I don't think, would actually pivot necessarily in terms of rates. They might pivot first in terms of the balance sheet, right? Because I do think that even if you have a massive sudden dislocation, whether it's sparked by Japan or China or something domestically here in the US, either way, they don't want to be seen as being whipsawed around short rates, but they can certainly still play with the balance sheet. So, little caveat, I think, on that end. But the Fed always does what it does in terms of acting with a lag also, meaning they respond to a crisis after the crisis. So it's not that I'm trying to be a perma bear by any means. I mean, anybody that's looked at my research and my work sees that I'm clearly not wedded to any particular longer term viewpoint, but history would suggest that if you have a credit event, the Fed steps in. They'll step in too late. The credit event and the pain would still have taken place. But yeah, to think that the Fed can't pivot just because we're this late in the year, it happened in 1987. What's to say it can't happen again?
During the interview, MichaelGayed noted that lumber's link to housing indicates risk-on behavior, while gold's safe haven status signals risk-off preferences. In a world where investors pay attention to only about a dozen stocks, using lumber prices as a market indicator may seem odd. But history has demonstrated that the lumber or gold relationship, used as a risk rotation trigger, has some predictive power in positioning investors appropriately ahead of market events. Michael is intrigued by China's future moves, especially in property markets, and believes industrial commodities could gain from global infrastructure rebuilding. The real estate market remains a major drag on China's economy and will have an impact on global growth, the International Monetary Fund, IMF, said last week. The developer, which has $190 billion in liabilities, had dodged default on multiple occasions in the past month. But persistent weakness in China's property market and a difficult refinancing environment had hobbled its ability to raise enough cash to service debt of $15 billion, falling due by June 2024. Earlier this month, it warned investors that it could default. Meanwhile, he also sees oil and gold as compelling investment options, particularly due to gold's diversification potential after a decade of underperformance. Let's get back to the interview.
Lumber is a play on housing. Housing is a big driver of economic growth activity, credit expansion, risk-on dynamics. Right? Lumber is highly correlated to housing starts. I am blown away how people don't really understand that. And yet they live in houses which would not be up there unless you had framing from lumber. Okay. Gold is, again, a risk-off safe haven. So you compare lumber's performance to gold's, and that tells you, on a go-forward basis, the likelihood of risk-on happening or risk-off. Risk-on being lower volatility dynamics for risk assets. Risk-off being higher volatility dynamics for risk assets. Not based on my opinion, based on historical back-tested fact. Now, I have to tell you, this is another thing that drives me crazy. Lumber to gold is a signal. But what is the look-back period? Okay, so what do I mean by that? Okay, well, a moving average is a signal for the stock market. But the conclusion of whether you're above a moving average or below moving average is a function of what look-back period are you looking at? Are you looking at a 2-day moving average? A 50-day moving average? A 10.5-day moving average? Because depending on the look-back period with the exact same signal, you get very different results. Right? It's like people forget there's a time aspect to looking at signals in terms of how far back you're looking for your trigger. In the paper looks at rolling 13 weeks. Why? Because, wanted to make it something that would probably not have as much turnover as obviously a shorter term time frame. My Roto ETF, which uses the same lumber to gold concept but uses a much shorter time frame, right, is trying to more tactically short term position offense or defense based on that lumber to gold relationship. Now, where we are now is interesting. Home builders have turned around pretty aggressively. Right, there was a huge disconnect between lumber prices and lumber prices going down, and lumber price and home builder stocks rising. Right, now they're actually confirming each other. Maybe it's nothing, maybe it's something. But the fact that home builder stocks are weakening, and by the way, lumber to gold is also now weakening, suggesting risk off is imminent, is intriguing to me around the corporate credit event thesis. That you're getting some kind of confirmation in these two important parts of the marketplace. So bottom line is it's not some magic relationship. There's a causation. Lumber is tied to housing. Gold is tied to risk-off safe haven behavior. You compare the two to each other. It tells you something about risk-on, risk-off volatility dynamics going forward. Not based on my opinion, based on fact. But if you're going to use it as a signal, you have to figure out which look-back period you want to look at to determine when to play offense and when to play defense. In general, it will be interesting to see what China does on a go-forward basis. Right? So we know their property markets are imploding now, but maybe they end up trying to reflate it and reinflate it in the years ahead. I do believe in general there's a lot of interesting research around how infrastructure is crumbling, not just in the US, but worldwide. So we will need to go through a renaissance of rebuilding, right? Which means that anything related to industrial commodities, right, construction materials, from a longer term perspective, should get a bid because we have to rebuild a lot of the infrastructure globally. But no, I think the obvious ones really are going to be oil in particular, and gold. Just again going back to the diversifier arguments. Look, you've had over a decade of lost performance in gold and commodities in general. That sounds like a buy.
In the evolving financial system, investors must monitor gold's performance closely. Gold's new major upleg should easily hit 25% gains and probably 40% before giving up its ghost. But gold only needs to rally about 4% from here, or 13% in total upleg terms, to start carving new record highs. How do you perceive the future of gold as an investment in the context of the increasing market volatility? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.